Global Payments, Inc. is a quintessential example of a true growth stock. As you can see, the company has grown operating earnings literally since it was spin off in 2001 at a very consistent double-digit rate of 17.53%. The company went right through the recession of 2008 and 9 like it wasn't there, growing earnings at 12% in '08 and 13% in '09. Even during COVID, the COVID crisis, it grew earnings by 3%. Earnings did flatten, but the company still actually grew. Watch this video to see how the price has reacted to that. Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation. And I've got a very interesting growth stock idea here today, Global Payments, Inc. And I wanted to show this company because I really love the consistency of its operating results over time. Now, it does pay a modest dividend, and it has had some dividend growth since 2019. But it's really not an income stock. It's more of a growth stock. However, the dividend is possibly becoming more relevant to this company going forward. But what I like about this company is the consistency of its growth through both recessions in 2008 and 9, since it was a public company, as well as the COVID recession that, of course, hurt a lot of companies pretty badly. So it does seem to have a recession resistance capability. And this is a stock that, as I'll show you when I look at price action, that has really got my attention here recently. So let's go ahead and go into FastGraphs. And let's start out looking at adjusted operating earnings. What you're seeing here are adjusted operating earnings consistently growing year after year after year. Even during COVID, we had modest growth, and they're expected to continue growing going forward. The average growth has been 17%. Now, even if I shorten the time frames here, I'm still getting over 60% growth. I do it for 15 years, I still got 16% growth. I do it for 10 years, I'm back to almost 18% growth. So we've got double digit, I'm going to call it 15 to 20% growth consistently with this company. Now, what's really important is, I've always said this over and over again, in the long run, earnings determine market price. And I've also said fundamentals matter, and they matter a lot. So when we put weekly closing stock prices on this graph, you can see that the company's stock price has followed their earnings growth consistently. Now, starting like we saw with a lot of companies in 2015 and 16, the company started to separate from its earnings justified valuation line, the orange line on the graph here, and it got really overvalued. Now, COVID came and we had a slowdown in earnings, and we saw, a flash crash like we saw with a lot of companies. But then the stock rallied again and got up to these really high multiples. The PE's gone up over 25, 28. And then, recently the company in their last quarter, in their third quarter, had some mildly disappointing. They actually met their earnings expectations, had a pretty good quarter, but the stock has fallen from a high of $217.80 in April of 2021 to currently just under $100, $99.77 as of yesterday's close. As you can see, the stock is now trading at a discount to its orange line. And I think the real lesson here is valuation matters, and it matters a lot. This is a classic example of how overvaluation can really affect your returns. And let's look at this historically so that we get this point clearly. Like we go back into 2006, the company was trading at a very high PE of, we'll call it 35.7. And if we go along here, for all these years, the company made no money for its shareholder. Any shareholder that bought it in March of 2006 would have literally barely broke even, actually had a slight loss of their money over the next 6 or 7 years or so. And that was all strictly valuation, because if we look at the bottom of the graph, and this is so important, I want to really iterate this point. Earnings growth was 28%, 16%, 12%, 13%, 14%, 9%, 27%. And then 3%. My point being, as we came into the recession and so on, but the only thing that was really wrong here was not that the company was doing poorly, but that the stock was overvalued. Now, in contrast, had we bought this stock when it was undervalued here, let's say in 2013, just as an example, and held it even to today's low valuation, we would have averaged over 17.6%. Interestingly enough, if I look at the long-term performance of this company going back to the maximum we can, which would be, the date would be May 31st, 2002 to 11/28/2022, so roughly 20 years, we see that the company generated a 12.59% annualized rate of return versus the Standard & Poor's 500 at 7.46%. Now, as you can see, the company did not pay much. They did pay a 4% token dividend for some reason back then, but they didn't really start a meaningful dividend program until 2019, where they actually paid a dividend of 22.5 cents. They did pay one dividend of 43% in 2017, but it's really not much of a dividend stock. It's really more of a growth stock, as I said, although dividends may become a more important role. And you can see that the payout ratio now has extended at least into the double-digit numbers, 10 and 12% payout ratio, which means there's still a lot of room for dividend growth if the company chooses to do that. But I really like the valuation. Now, let's look at some other metrics here. Let's look at diluted earnings. One of the things about this company, a lot of you will look at websites and see diluted earnings. You're going to tell me, the PE ratio is 125 like we see here. The reason for this is diluted earnings, or GAAP, if you will. They include a lot of non-cash charges, one-time events, and so on. And one thing that this company has done is it's grown inorganically to a great extent by making several acquisitions over time. The most recent acquisition was Evo Payments, which, the company made. And you can, when you're doing your own research and just look into it, they've recently bought this company, and they're also going to divest some things. But getting back into global payments, so from a standpoint of GAAP earnings, you're going to see a lot of inconsistency in GAAP earnings. I want to look at operating cash flow because you're going to see some inconsistencies in operating cash flow, although really since 2012 or 13, the cash flow growth has been very, very strong. And similarly, we see the same thing with free cash flow. Free cash flow has grown at a very high rate since roughly 2013 or 14. It's grown at over 24%. And of course, it massively covers the dividend. So we've got really strong cash flow growth. And things like EBITDA, growth has been pretty consistent as well, not as consistent as operating earnings. And then finally, I think what's important here is that revenue have also grown at double-digit rates, about 11%. You can see the company stock price got dramatically ahead of revenues, but has now come into what I would consider a fair valuation based on price to sales. So, the company looks like it's an attractive buy now. Now, let's dig a little deeper. Operating earnings basis, you can see that the company stock price has tracked operating earnings and is currently trading at a bargain. A lot of that has to do with the market sentiment that we've been facing here recently. So let's go into the financials a little bit, and let's look at some of the important metrics here using the fiscal fitness portion of fast graphs here under the financials. Number one is we do see that free cash flow does cover the dividend, but again, dividend is not that important here. Operating cash flow growth has been strong for the last 10 years. That's one thing I like to see. We can click the growth button here, and we see that it's, grown at very strong rates year after year. Now, one thing that makes some of these calculations difficult, and I want to point this out now, the company in 2016 went from a May fiscal year to a calendar or a December fiscal year. So you see this gap here in the data where we had this extended period of time as they transitioned from a May fiscal year. So we had about 7 months here added to a normal fiscal year. So it kind of screws up the data a little bit. I want to look at share buybacks a little bit because right now the company has about $1.5 billion share buyback program, which I like that very much when you're considering that the stock has gotten this cheap now. But I want you to notice that what the valuation was in 2021 and 2022. And the reason I mention that is because the company actually issued shares in 2020 and 2021. Let's look at that again. So we've got 2021. We had very high valuations in 2020. We had very high valuations. So the company actually raised capital during the period when their stock price was inflated. And I actually like that very much. So, and I like the fact that they've now instituted a share buyback, and they did announce their regular 25-cent dividend as well. Their operating cash flow is greater than their net income, which I consider a positive. Again, ignore this gap. Really, it might only pay to look at the last, 5 years, 5 actual years here that are under this, December fiscal year. Because, once they transition from a May fiscal year to December, that kind of screws up the data reporting a little bit, but it just makes it more confusing. Sales revenue has grown very nicely at over 22.89% since they made that transition. Their margins have been good, but not great. They've been better than industry average, so I kind of like that. Their net margin just recently has improved and gotten better than industry average. Returns on assets, returns on equity, and returns on invested capital are a little low for this company. A lot of that has to do, I think, with some of the acquisitions they're making, which has, effects on their equity, and the fact that they had been borrowing money. They did a deal with Silver Lake Partners for, I think, about $1.5 billion to make this recent acquisition. So it's a very interesting company with a very consistent earnings growth rate. It has grown inorganically by acquisitions. Now, a couple of things about this company. I'm going to turn to Zacks Investment Research here and look at the company from a standpoint of, their last earnings report. And they reported their earnings report, and they missed the Zacks consensus estimate by a whisker. So they really didn't miss it. They made it. But the bottom line rose 14% year over year. GPN's adjusted net revenues only advanced 3% year over year to $2 billion, and the quarterly results were hampered by elevated operating costs resulting from higher selling, general, and administrative expenses. However, they claim it was offset by sound contributions from its merchant and issuer businesses. The merchant business is their big business. So you can go through here if you're a subscriber to Zacks. I've done a lot of research. I'm not going to bore you with all the details here, but there's a lot of information you can learn. The full Zacks report, I think, is important because they give reasons to buy. They say the company gave strong 2022 guidance. The guidance that they gave for 2022 and 2023 is actually higher than the company's actual earnings estimates, that are being reported by analysts. And I think that's kind of important. Analysts are reporting about 933, and the company's guiding at 953. So we're looking at the company is a little more confident, I guess, than the analysts are. And inorganic growth is a very important part. That's why you've seen the GAAP earnings so, bouncing around all the place, not being anywhere near as consistent as the operating earnings, because the company is known to make strategic acquisitions to grow its business. They recently did the Evo, but they also had buyouts like APT, PayPros, Heartland. The company also made the acquisition, or actually a merger of Total System Services. That was one of their biggest deals. And then Zago, Mineral Tree, and others. They're investing heavily in technology. It's very important for them. And they also have these strategic partnerships that are critically important, and that includes with some of the players like Alphabet or Google. They also are doing business now with Amazon Web Services. The company does have strong investment-grade balance sheet, according to Zacks, and they have stable free cash flow generation, which gives them ample capital and financial flexibility, and that would allow them to continue to grow. Now, they also were negotiating a deal with FIS to kind of do a big merger, but that deal has fallen through from last I can tell. One of the reasons I like Zacks is they give reasons to sell. They're saying costs are rising, issuing business to remain under pressure. The performance of the company's issuer solution segment is still under pressure due to the transition efforts pursued to make it more tech-enabled. So they're spending money there. Return on equity of 9.9% is way lower than the industry average, and this shows its inefficiency in using its shareholder funds. So that's something, to be concerned about and to look into. But generally, the company is growing very well. Looking at it from a future growth point of view, analysts are expecting the company to grow at about 12% in fiscal 2023. And again, this number, this estimate here for 2022 is lower than company guidance. Guidance is estimating 953, but that's not going to be material. The long-term growth rate is also considered to be about 13%. Now, like I always do, I like to check other sources. For example, you could go into Yahoo Finance here. This isn't an apples-to-apples comparison. It's long-term growth to 5-year growth, so it's close. The analysts reporting to Reuters are saying 14% growth. FastGraph gets their analyst estimates from FactSet. The FactSet group of analysts, of which there are 6, reporting on long-term growth are saying 13%. If I look at the company at a normal multiple of 23 or 24 times earnings for the last 5 years, but I can also look at more reasonable normal multiples, and I kind of like this 19 or 20 multiple as what would be normal. That would value the stock at about 185.87 if they were to trade at a normal multiple. Now that's kind of important because another research service that I like to use is Morningstar, and Morningstar gives it 5 stars right now, and they say fair value is 186. Well, that's in line with what I just showed you. They did say that, they reported third quarter results that were weighted down by the stronger dollar, and the exit from Russia, which obviously they did because of the war, and a divestiture. They've also did a little divestiture of one of their divisions, and their adjusted net revenue was just up 3%, as Zacks reported. But the merchant segment grew over 7%, excluding the exit from Russia, it would have been 11%. Meantime, the firm's issuer segment generated revenue growth of only 2%. But, they are very, confident in the company now. Their 186 per share value equates to 20 times 2023 earnings per share. Okay, I want to make that clear because, they are saying that it's worth, a high multiple. If we use the FastGraph more conservative view of only a 15 multiple, of it deserving a 15 multiple if it does grow at 13% for the next couple of years, that still puts it at $140 a share, up from $99 a share it's currently trading at. So I do believe the stock has a modest margin of safety at these current levels. Again, I like the company for how it consistently has reported adjusted or operating earnings. Again, remember there's this, this little bit of gap in the way the reporting was done because of moving from a May to a December fiscal year. They did that in 2016, obviously. So, but if you look at the company, just through those years, you still see a very strong, consistently growing company. I think the real lesson here is valuation. The stock was trading at very high valuations and did that for several years. The market was very complacent during those years. I talked about it all the time. I was told I was crazy. But, valuation matters, and it matters a lot. The stock has now fallen into not only fair value, but below that, giving us a margin of safety. So if you're looking for growth and a modest dividend income and maybe modest dividend income growth, I think Global Payments might be a stock that you might want to take a closer look at. It has reasonable levels of debt, a healthy balance sheet. It's investment grade, BBB minus rated. And, we're buying it today at, one of the lowest valuations we've been able to buy it at in several years. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, kind of giving you a deeper dive into global payments. This is one I covered in my subscriber request yesterday. I've had several subscribers request it. I do like the company very much. I like what I see. It's a little bit tricky. There's an awful lot you can learn about the company by going through their research. I read their earnings report, which was, published on October 31st, I think. I'd suggest that you do that because, as I always say, there's no substitute for comprehensive research and due diligence. But the more I look at this company, the more I actually like it from a standpoint of current valuation. I think any risk in this stock is already priced in, and I do think things are going to improve. And I think that Evo acquisition is going to be giving them an opportunity to increase their revenue growth. So, there's a lot to look at. I just obviously skimmed the surface here in this video. But anyway, if you like this video, give me a like, ring the bell, subscribe to the channel. And once again, take a look at FastGraphs. It gives you so many opportunities to really do deep dives on these stocks. And it just really lays all the financial data up for you so that you don't have to spend hours trying to find it through other financial sites or going through financial reports. Thanks for watching. Be talking to you again real soon.